Alright, as promised, here is the quick tutorial on how to take your profit and loss statement out of QuickBooks once you've downloaded it into Excel format and put it into the template that I have uploaded that you've got on your system. So we're basically just going to copy all the data out of the profit and loss statement, and then we're going to go back into this file and we're just going to paste it in there. And these formulas, so the data will appear once there's data over on the left side. I've got just a template of a pest control company that does a home service-based business, and what it's going to do is it's going to give us a few things. We'll start here. What it's doing is it's calculating an average of the prior months. So in this case, these statements are through July of 2025, and it's calculating the average for the 5 months prior. What we're going to do is we're going to compare July to that average, to those results. And what we see is that July's revenue is up a little over $2,800 versus the average of the prior 5 months, which is almost 6%. So in any measurable world, the 6% increase in revenue is great. If we scroll down a little bit, we can see in certain areas where things might have gone up or down depending on different scenarios. If we look at this line here for contract labor, what we'll see is that it's been averaging about 22,000, but in July, for whatever reason, it's a little lower than that, and that's almost a 6% decrease. So that's good that our expenses are down and our revenue is up in the key areas, but there are key accounts you're going to want to verify those kinds of changes in. So that's what that exercise does. It uses the lens of comparison to say, okay, the month that we just closed, how does it compare to the average of what we've been doing? Not just the prior month, but the average. And that can take into account seasonality. It can take into account changes in staff, changes in offerings of services that you provide or products. So that way you can look at it at a more general level, averaged out. The other component that this will do is it will wind up calculating a percentage of the revenue. So if we look at, in this case, the chemicals line, it's going to say, hey, if I look at chemicals for the total period here, I'm going to see that it's about 22.6 compared to a percentage of the revenue. It winds up being about 8.28% out of that 273 total in revenue. So what this can do for you is it can basically allow you to see if your costs are scaling with your revenue. So if your payroll shot up dramatically, but your revenue is staying flat, that would be an area where you could decide if you needed to have that level of payroll or if you potentially needed to cut back. In an area like cost of goods sold, you would expect to see these directly increase as revenue does because they're direct costs for the service that this company is providing. Similarly, you might see advertising increase along with revenue. The thinking being that if we spend more on advertising, we're going to get more in the world of revenue. So that's a way that you can compare between what the data says and what you're actually getting to understand if things are moving in the right direction. So again, if your costs dramatically rose but your income stays flat, that's a problem. And that can cause issues downstream with the business. So hopefully this makes sense. It's helpful. If you need more clarity, if there's something I can do to help out with this, reach out. Happy to help.